Okay, let's dive right into this explainer. Today, we're demystifying one of the most critical and, honestly, most fascinating frameworks in modern accounting. We are building a logical, architectural blueprint of IFRS 9 financial instruments. Now, for accounting students and professionals alike, this standard can often feel like a massive, tangled web of rules. But by treating it like a construction project, we're going to break it down into perfectly structured, manageable pillars.
Here's our roadmap for today. 1. Objective and scope. 2. Recognition and classification. 3. Measurement and impairment. 4. Hedge accounting. 5. Application and judgment. And finally, 6. Summary and final recap. Let's get to it.
All right, Section 1. Objective and scope. So, what's the actual goal here? The core objective is predictability and transparency. Why does this standard even exist? Because investors and stakeholders absolutely need to know the exact amount, the timing, and the uncertainty of future cash flows. Imagine a regional bank issuing a standard 30-year mortgage. IFRS 9 provides the strict engineering principles required to report that asset so that anyone reading the financial statements gets a perfectly clear, realistic view of the bank's true financial health.
Now, where exactly does our blueprint end? Well, we have absolute exclusions. We completely leave out things like insurance contracts governed by IFRS 17, forward contracts for business combinations under IFRS 3, employee benefit plans under IAS 19, and share-based payments under IFRS 2. Why? Simply put, they've got their own highly specialized rulebooks. On the flip side, IFRS 9 relies heavily on vital links to other standards. It tightly connects to IAS 32 for presentation, and of course IFRS 7 for the massive disclosure requirements that accompany these instruments.
Moving right along to Section 2, Recognition and Classification.
Taking an instrument off the books, what we call derecognition, requires entirely different logic depending on if you're dealing with an asset or a liability. For assets, we ask a fundamental economic question. Did we transfer substantially all the risks and rewards of ownership to someone else? If we shared those risks, then we have to look at who actually controls the asset. But for liabilities, it's strictly legal and mathematical. We test if the obligation was legally extinguished, or if the terms were modified, we run a strict math test to see if the present value of those cash flows changed by at least 10%.
And that brings us to the two-step sorting mechanism for financial assets. This is literally the heart of classification. Step 1, what is the entity's business model? Are they holding this asset just to collect the contractual cash flows, or are they actually planning to sell it? Step 2 is the SPPI test. You look right at the contract itself and ask, do the cash flows consist solely of payments of principal and interest? It's a very strict test of the instrument's basic, vanilla nature.
Depending on how an instrument performs on those two tests, its fate is decided. Say a local bakery buys a simple government bond to hold until maturity. That passes both tests with flying colors and lands comfortably in the amortized cost category. But if a company holds complex derivatives that completely fail the SPPI test, boom, they immediately drop into the volatile fair value through profit or loss bucket. Financial liabilities, on the other hand, are a bit simpler. They generally just default to amortized cost unless they're actively held for trading.
Now, in accounting, the exceptions are honestly just as important as the rules. Pay close attention to this one. Entities can make an irrevocable election on day one to put certain non-trading equity investments into FVOCI. Why does that matter? Because it keeps the wild, unpredictable market swings of the stock market right off the company's main income statement. And for our linkage rules, remember that if you have a compound instrument, like a convertible bond, you have to immediately link over to IAS 32 to split it up into its separate equity and liability pieces.
Okay, Section 3, Measurement and Impairment.
Let's establish our starting point. At the exact moment of initial recognition, we measure these financial instruments at their fair value. And generally, we add in the transaction costs, the fees and commissions it took to actually acquire the item. But there's a major carve-out here. If the item is held for trading and sits in the fair value through profit or loss bucket, those transaction costs don't get added in. They are just immediately expensed to the income statement.
Now we get to the truly revolutionary part of IFRS 9. It completely threw out the old, delayed, incurred loss model and replaced it with a predictive timeline, the expected credit loss, or ECL model. We don't wait for a default to happen anymore. Nope, on day one in stage 1, we immediately record a 12-month expected credit loss. The very second that credit risk significantly increases, it shifts into stage 2, and we suddenly have to recognize the expected losses over the entire lifetime of the asset. So what happens if you change the rules mid-game? Say a bank decides to renegotiate the terms of a struggling borrower's loan without legally extinguishing it. Well, they can't just ignore that change. They have to mathematically recalculate the gross carrying amount based on the new cash flows discounted at the old interest rate and instantly recognize a modification gain or loss right there in the profit or loss statement.
There's a vital rule for the expected credit loss model, though. You absolutely never apply it to equity instruments, and you never apply it to assets measured at fair value through profit or loss. Why? Because the fair value measurement is already capturing those credit risk changes in real time automatically. We also rely on some really vital links here. We use IFRS 13 to dictate the math for calculating fair value, IFRS 15 for a simplified impairment approach on trade receivables, IAS 1 for how we present these gains and losses, and IAS 12 to handle the resulting deferred tax impacts.
All right, on to Section 4, Hedge Accounting.
IFRS 9 does a beautiful job of aligning accounting with an entity's real-world risk management strategies. Whether it's a local bakery entering a contract to lock in the future price of wheat to protect their cash flows, or a massive corporation using interest rate swaps to protect the fair value of their fixed-rate debt, this framework ensures the accounting reflects the actual economic reality of those protections rather than just creating artificial volatility on the balance sheet.
There's also a fantastic built-in safety valve to fix accounting mismatches. Sometimes, the rigid classification rules force an asset and its related liability into totally different measurement buckets. That creates a mismatch, making the company look artificially volatile. Well, IFRS 9 allows management to optionally designate both items as fair value through profit or loss, right from the very start. That restores logical economic balance to the financial statements.
Looking at our hedging exceptions, a highly tested area for students is that written options can almost never be used as hedging instruments. Why is that? Because writing an option exposes the issuer to theoretically unlimited loss. That increases risk, it doesn't hedge it. Also, take note of our linkage here. Because macro hedging is so incredibly complex, IFRS 9 actually allows banks and entities the option to link back and stick with the older IAS 39 rules specifically for portfolio hedges of interest rate risk.
Moving to Section 5, Application and Judgment. When inspecting asset transfers, accountants really have to play detective. You have to cut through the legal paperwork to find the true economic substance. If you sell a receivable unconditionally, the asset is gone, derecognize it. But if an entity enters into a repurchase agreement, a repo, where they sell an asset but promise to buy it back later, they haven't transferred the risk at all. The economic reality is that it's just a secured loan, so the asset stays firmly on the balance sheet.
The practical application of this standard relies heavily on professional judgment. Deciding if you retain control of a partially transferred asset or executing that precise 10% math test for liability modifications, it's rarely black and white. And because so much judgment is involved, it directly triggers the extensive disclosure requirements mapped out in our link standard IFRS 7. You explicitly have to explain to users the qualitative reasons why you classified or changed the measurement of these complex instruments.
Finally, Section 6, Summary and Final Recap. Think of this recap as your ultimate study guide. It beautifully consolidates the boundaries of our major pillars all in one place. We see our strict exclusions, like keeping insurance and share-based payments out of scope entirely, and vital exceptions, like that irrevocable fair value equity election we discussed. We also see exactly how this framework connects to the rest of the accounting universe, linking out to IAS 32 for presentation, IFRS 13 for fair value math, and IFRS 15 for trade receivables.
As we wrap up this explainer, I want to leave you with a provocative thought. IFRS 9 was born out of the ashes of the global financial crisis, a time when old rules forced banks to wait until the loss was actually incurred before reporting it. By forcing entities to record expected credit losses on day one, how does the predictive nature of IFRS 9 not just record history, but actively prepare our financial institutions for the very next economic storm? Think about it. Keep questioning the framework and keep learning.